Good morning, everybody. Welcome to my presentation. Today I will be presenting on Shell PLC. So to start, I'd like to give a little bit of background information on this company. Shell PLC is a UK-based oil and gas company. They primarily focus on exploring and developing upstream, midstream, and downstream oil fields. So that is like the extraction, sucking oil out of the ground, transporting the oil, and the distribution of oil to various vendors. That's kind of what that involves. Shell also works to extract liquefied natural gas, which is LNG, and they also own a chemical products company as well, kind of based off their oil development, using oil to produce different chemicals and such. Shell has also set the goal to have net zero emissions by 2050, and it is exploring green energy product lines. I don't believe any of them are profitable as of yet, but it is starting to look into that field to kind of turn towards the future. Shell suffered a net loss in 2020 of approximately $17 billion, which is quite large. However, in 2021, it had a times interest earned ratio of 8.16, a current ratio of 1.345, a quick ratio of 1.077, and a cash ratio of 0.392. So as you can see up here, it likely indicates that despite the net loss in 2020, Shell can still meet its financial obligations. However, using just cash alone would probably not be enough to be able to meet these obligations if they came due all at once. So it does seem healthy, but not exactly, it wouldn't be able to pay off all of its debts without altering its structure significantly. This is kind of a little bit of an explanation as to potentially why the oil price, or rather the company, suffered such a large net loss in 2020. As you can see right here, there was a large drop off in the value of crude oil right around 2020. Spring of 2020, oil fell, partially due to the COVID-19 pandemic, partially due to other foreign factors such as OPEC and things like that. And it's a potential explanation for why they had such a large net loss in 2020. And then as well, with the pandemic, you had a large drop in consumer demand as people weren't leaving their houses as much or driving as often, which caused the oil price to probably stay lower and for them to not sell as many barrels of oil. And moving on to the Shell stock price. As you can see, over the past 5 years, the S&P 500 has outperformed Shell stock. However, in the past year, Shell has outperformed the S&P 500 slightly. So that's a relevant factor to consider when looking at these stock prices. So as I mentioned, it has outperformed the stock market over the past year, but the market has better returns over the past 5 years. And in fact, if we go back here and look at the oil price, if you had bought the stock here 5 years ago, the stock would still be lower today had you held on to it for a full 5 years. So the S&P 500 is likely a better over the past 5 years investment. However, Shell does have a lower PE ratio than peer companies Chevron and Exxon. As you can see, Shell has a PE ratio of 5.58, while Chevron and Exxon have 11.57, 11.56 respectively. So it could indicate that Shell is potentially undervalued compared to some of its peer companies. Overall, however, my recommendation is not to buy the Shell stock. I do believe it has solid financials, but I think due to the fact that Shell is seeking to dramatically alter its business model by 2050, as I mentioned, to expand into a net zero production and explore more green energy products, the company that you'd be buying today might not be the same company that you buy in the future as it tries to kind of shift and dramatically alter its product line. The beta may not be the same, and certain other things may not be similar as well. So for that reason, I would not recommend buying the stock. Thank you for your time. Is there any questions?